On May 16, 2008, Matthew Lee, a senior vice president in Lehman Brothers' finance division with responsibility for the firm's global balance sheet, sent a 5-page letter to senior controllers, the firm's auditors at Ernst Young, and the head of internal audit. Paragraph 4 flagged that Lehman was moving approximately $50 billion of inventory off its balance sheet at each quarter end through transactions the firm internally labelled Repo 105. 6 weeks later, Lee was terminated. Ernst Young met with Lehman's audit committee about his allegations on July 8, 2008. The Repo 105 program was not disclosed to that committee, to investors, to the SEC, or in any public filing. The structural question this episode answers is how a routine secured financing transaction, modified by a 5 percentage point haircut, produced a reporting outcome that reduced Lehman's publicly disclosed leverage by tens of billions of dollars at the precise moments the market measured it. The instrument at the center of this case is the repurchase agreement. A repo, in standard form, is a short-term collateralized loan. The borrower transfers securities to a counterparty in exchange for cash. The borrower then agrees to repurchase those securities at a slightly higher price on a specified future date, often the next day. The difference between sale price and repurchase price is, in economic substance, interest. The securities function as collateral. Repos are one of the most heavily used financing tools in global capital markets, and on any given day a major broker-dealer like Lehman conducted hundreds of billions of dollars in repo activity. Under US generally accepted accounting principles, reporting treatment was governed by Statement of Financial Accounting Standards 140, which addresses transfers of financial assets. SFAS 140 establishes a control-based test. If the transferor retains effective control over the securities, the transaction is accounted for as a financing. The securities stay on the transferor's balance sheet. The cash received is recorded as a liability. Leverage is unchanged, because an asset has been exchanged for cash of equal value, with an offsetting obligation to repurchase. If the transferor does not retain effective control, SFAS 140 requires true sale accounting. The securities come off the balance sheet. The cash received is recorded as proceeds. There is no repurchase liability, and if that cash is then used to pay down other liabilities, total assets and total liabilities both decline. Leverage ratios improve. What constitutes effective control? SFAS 140 provided a specific quantitative threshold. A transferor was deemed to retain effective control if it had the right and obligation to repurchase the transferred assets, and if the cash collateral it received was sufficient to allow the counterparty to repurchase substantially similar securities in the open market. Interpretive guidance established that over-collateralization above a certain level meant the transfer had not retained effective control because the counterparty held more cash than it needed to source replacement securities. The practical industry threshold that emerged was 102% for ordinary securities. A repo at 102% collateralization was a financing. A repo at 105% for fixed income or 108% for equities was deemed a sale. This is the pivot. The difference between a repo accounted for as a financing and a repo accounted for as a sale was not a difference of economic substance. In both cases, Lehman transferred securities, received cash, and committed to repurchase the securities at a fixed price within days. In both cases, the firm bore the economic risk and reward of the securities throughout. Only the accounting treatment changed at the 105% threshold. Above the line, one report. Below the line, a different report with the securities removed entirely from the balance sheet. According to the report of the examiner in the Lehman Brothers bankruptcy proceeding filed by Anton Valukas in March 2010, Lehman could find no US law firm willing to provide a true sale opinion on Repo 105 transactions under New York law. The firm instead obtained an opinion from the London office of Linklaters, which concluded that under English law, a repo with the requisite over-collateralization could be characterized as a true sale. Lehman therefore routed the Repo 105 transactions through its London-based broker-dealer subsidiary, Lehman Brothers International Europe. The US parent transferred securities to LBIE. LBIE then executed the Repo 105 transactions with European counterparties. The mechanism worked as follows. Step 1. In the days leading up to a quarter-end reporting date, Lehman's traders identified an inventory of liquid securities, primarily government bonds and high-grade fixed income instruments that could be moved out of the firm's balance sheet measurement. The examiner's report established that the volume of Repo 105 activity scaled with the firm's need to meet leverage targets. In Q1 2008, the volume executed reached approximately $49.1 billion. In Q2 2008, approximately $50.4 billion. Step 2. The securities were transferred to LBIE in London. LBIE entered into repurchase agreements with European counterparties, transferring the securities at a discount of approximately 5% to market value. For every $100 of fixed income securities transferred, LBIE received approximately $95 in cash. The counterparty was over-collateralized by 5% above the cash extended. Step 3. Because the over-collateralization met the 105% threshold, and because the Linklaters' opinion supported true sale treatment under English law, Lehman accounted for the transactions as sales. The securities came off the consolidated balance sheet. The cash received was recorded as proceeds. Step 4. The cash proceeds were used to pay down other short-term liabilities. On the quarter-end reporting date, both the asset side and the liability side of Lehman's balance sheet contracted by the amount of the Repo 105 transactions. Total assets declined. Total liabilities declined. The net leverage ratio computed as net assets divided by tangible equity capital improved. Step 5. Within 5 to 10 days after the quarter-end date, Lehman repurchased the securities from LBIE's counterparties at the contractually specified repurchase price, which incorporated a small financing cost. The securities returned to the balance sheet. The liabilities that had been paid down were re-established. The firm's leverage ratio returned to its true operating level. The transactions were, in every economic dimension other than accounting treatment, indistinguishable from ordinary repos. Lehman retained the upside and downside on the transferred securities. Lehman bore the cost of the 5% over-collateralization, which functioned as a fee for the right to apply true sale accounting. The examiner's report estimated that Lehman incurred substantial incremental funding costs to execute Repo 105 transactions over ordinary repos. These costs were paid because the accounting outcome had a value that exceeded them. That value existed because Lehman's net leverage ratio was watched closely by rating agencies, by counterparties, and by equity analysts. The firm had publicly committed to reducing leverage in the wake of the Bear Stearns collapse in March 2008. In its Form 10-Q for Q1 2008, Lehman reported a net leverage ratio of 15.4. The examiner's report calculated that without Repo 105, the ratio would have been approximately 17.3. In Q2, the reported ratio was 12.1, without Repo 105, approximately 13.9. The examiner's report further found that the volume of Repo 105 transactions had grown materially over time. In 2006, typical quarter-end volume was in the range of $25 billion. By 2007, approximately $35 billion. By the first half of 2008, approximately $50 billion. The growth tracked the deterioration of Lehman's underlying balance sheet position. The mechanism was being deployed more intensively as the firm's actual leverage rose. The program had a formal internal policy document titled the Repo 105-108 Accounting Policy. It was approved by senior finance personnel. Trader manuals included instructions on the program. The examiner's report documented internal emails in which senior personnel discussed the mechanism explicitly. One Lehman executive referred to Repo 105 as an accounting gimmick. A senior finance officer described the firm's quarter-end activity as window dressing. The program was not disclosed in Lehman's Forms 10K or 10Q. The transactions were not separately identified in the notes to the financial statements. The MD&A section, which under SEC rules required disclosure of known trends and uncertainties material to the firm's liquidity and capital resources, did not reference the practice. Investors reading Lehman's public filings saw a leverage ratio that the firm had achieved, not a leverage ratio that the firm had temporarily constructed for the measurement date. The detection failure has 4 components. Each illuminates a different point in the verification chain. The first component is the auditor. Ernst Young served as Lehman's external auditor throughout the relevant period. Under US auditing standards, the auditor's responsibility is to obtain reasonable assurance that the financial statements are free of material misstatement, whether due to error or fraud. The examiner's report established that Ernst Young was aware of the Repo 105 program. The firm reviewed the accounting policy. It examined the transactions. It accepted the Linklater's opinion and the application of true sale treatment under SFS 140. The question is not whether Ernst Young knew the transactions were occurring. The question is whether the transactions, even if technically compliant with the letter of SFAS 140, were material to investors in a manner that required disclosure beyond what Lehman provided. The New York Attorney General's office filed a civil complaint against Ernst Young in December 2010, alleging that the firm had assisted Lehman in misleading investors by failing to question the lack of disclosure. That action settled in April 2015, with Ernst Young agreeing to pay $10 million to the state of New York without admitting wrongdoing. The structural observation is that auditor verification under SFAS 140 was framed as a transaction-level inquiry. Did each transaction meet the technical threshold for sale accounting? The auditor's questions stopped there. The broader question, whether the aggregate effect of the program constituted a material distortion of the firm's financial position that required separate disclosure, was a judgment call that the auditor did not press. The second component is internal control. Matthew Lee's letter of May 16, 2008 was a formal whistleblower disclosure under Lehman's internal procedures. The letter identified Repo 105 by name. It quantified the volume at $50 billion. It stated that the program was used to reduce the firm's balance sheet at quarter end. Lee was a senior vice president with direct visibility into the firm's balance sheet operations. His allegations were not anonymous, not vague, and not speculative. The examiner's report found that Ernst Young met with Lehman's audit committee on July 8, 2008 to discuss Lee's allegations. The report further found that during that meeting, Ernst Young did not inform the Audit Committee about the Repo 105 program, despite Lee having identified it specifically in his letter. The Audit Committee did not learn of Repo 105 until after the firm's bankruptcy. The whistleblower channel functioned as a closed loop. Lee disclosed to the auditor. The auditor met with the Audit Committee. The specific concern Lee had raised did not surface in that meeting. The channel was nominally operative but produced no escalation to the body with authority to require disclosure or halt the practice. The third component is the regulator. The SEC's Division of Trading and Markets had on-site staff at Lehman's headquarters under the Consolidated Supervised Entity Program, established in 2004 to extend SEC oversight to the holding companies of major broker-dealers. CSE program staff received Lehman's internal risk reports. They had access to balance sheet data on a frequent basis. The CSE program was not designed to detect quarter-end accounting maneuvers. Its focus was risk concentrations, liquidity, and capital adequacy as measured by the firm's internal models. The leverage ratio Lehman reported publicly was constructed under GAAP. But the SEC's prudential oversight relied on different metrics. The two systems did not reconcile in a way that would have flagged Repo 105 to regulators monitoring the firm's risk profile. The SEC's Office of Inspector General later issued a report in September 2008, immediately following Lehman's collapse, finding that the CSE program had identified concerns about Lehman's risk management, but had not pursued enforcement. The fourth component is the rating agency. The major rating agencies maintained ratings on Lehman's debt throughout the relevant period. Their methodologies incorporated leverage ratios as inputs. The ratings were based on the publicly disclosed financial statements. The rating agencies did not have independent access to Lehman's internal records and did not conduct forensic accounting reviews of the firm's balance sheet construction. They relied on the audited financial statements. Repo 105 distorted those statements in a manner the rating agencies were not positioned to detect. What would have had to be true for detection to occur earlier? At least one of the following. The auditor would have had to take the position that the program in aggregate was material to investors and required disclosure regardless of technical compliance with SFAS 140. Or the Audit Committee would have had to receive direct notice of the program and inquire into it. Or the CSE program would have had to expand its remit to include quarter-end balance sheet construction as a supervisory concern. Or a market participant would have had to compare Lehman's intra-quarter and quarter-end positions and identify the systematic pattern of contraction at reporting dates. None of these occurred during the firm's operating life. The unravelling proceeded along two parallel tracks. The first track was the firm's collapse. On September 15, 2008, Lehman Brothers Holdings Inc. filed for protection under Chapter 11. The filing was the largest bankruptcy in US history at that time, with reported assets of approximately $639 billion. The proximate cause was a liquidity crisis. Counterparties had withdrawn funding. The firm could not roll its short-term obligations. The Federal Reserve and Treasury declined to provide bridge financing or to facilitate an acquisition on the terms that had supported Bear Stearns 6 months earlier. Repo 105 did not cause the collapse. The collapse was caused by the firm's underlying positions, particularly its commercial real estate and residential mortgage-related assets, which had deteriorated in value to the point that counterparties no longer believed the firm's solvency. What Repo 105 had done in the preceding quarters was obscure the trajectory of the firm's leverage from investors and analysts who might otherwise have priced the risk differently. The second track was the post-collapse investigation. The bankruptcy court for the Southern District of New York appointed Anton Valukas, chairman of the Chicago law firm Jenner and Block, as examiner under Section 1104 of the Bankruptcy Code. The examiner's mandate was to investigate the causes of the failure and to identify any colorable claims the estate might pursue. Valukas and his team conducted a multi-month review with full access to Lehman's books, records, and personnel. The examiner's report was filed on March 11, 2010. It ran to over 2,200 pages across 9 volumes. Volume 3 was devoted to Repo 105. The report established the existence of the program, its mechanics, its scale, its accounting treatment, the role of the Linklaters opinion, the absence of disclosure, and the awareness of senior personnel. The report concluded that there were colorable claims against certain Lehman officers and against Ernst Young. Publication converted Repo 105 from an internal practice into a matter of public record. The financial press reported on the findings. Congressional hearings followed. The SEC opened an investigation. The SEC's investigation did not result in an enforcement action against Lehman as an entity, because the firm was in bankruptcy and the holding company Shell had no operating value. It did not result in enforcement actions against individual former Lehman executives. In 2012, the SEC closed its investigation of individual Lehman officers without filing charges. The agency did not publicly explain the decision in detail beyond statements indicating that the available evidence did not support charges that could be sustained. The New York Attorney General's civil action against Ernst Young, filed in December 2010 under the Martin Act, proceeded separately. The complaint alleged that Ernst Young had assisted Lehman in publishing financial statements that were materially misleading by virtue of the undisclosed Repo 105 program. The case settled in April 2015 with the $10 million payment described earlier. A securities class action filed by Lehman investors named Ernst Young and various former Lehman officers and directors. That case settled in 2013 with Ernst Young paying $99 million and the former officers and directors paying $90 million, in both cases without admission of liability. The accounting profession responded through the Financial Accounting Standards Board. In April 2011, FASB issued Accounting Standards Update 2011-03, Reconsideration of Effective Control for Repurchase Agreements. The update modified the criteria in what was by then ASC Topic 860, the successor codification to SFAS 140. Specifically, the update removed the provision that had based the effective control assessment on whether the transferor had received cash collateral sufficient to allow the counterparty to repurchase substantially similar securities. The criterion that had supported the 105% threshold was eliminated. Under the revised standard, the analysis of effective control focused on the transferor's contractual rights and obligations, not on the level of cash collateralization. The practical effect of ASU 2011-03 was that repurchase agreements with the economic substance of a financing could no longer be recharacterized as sales by adjusting the level of over-collateralization. The accounting outcome was forced to align more closely with the economic substance of the transaction. The The structural opportunity that had supported Repo 105 was closed. The SEC, separately, in September 2010, issued a request to major financial institutions for information about their use of repo transactions at quarter end, with the specific purpose of identifying window dressing practices. In 2011, the agency proposed enhanced disclosure requirements for short-term borrowings, including disclosure of the maximum daily amount of short-term borrowing during a reporting period and the average daily amount in addition to the period end amount. These proposals would have made it more difficult to obscure the divergence between intra-period and period-end positions. The proposals were not adopted in final form during the immediately following period, but disclosure of average and maximum borrowings did become a regular feature of subsequent guidance and practice. What the Lehman case establishes about the mechanism is the following. First, an accounting threshold defined in quantitative terms creates a structural opportunity to engineer transactions to the threshold rather than to economic substance. SFAS 140's effective control test was a bright line. 5% over-collateralization on one side produced one accounting outcome. The same transaction with 2% over-collateralization on the other side produced a different outcome. The bright line, intended to provide clarity, defined the precise location of an arbitrage. The cost of crossing the line was 3 percentage points of collateral. The benefit was a balance sheet reduction with no economic equivalent. A rational firm under pressure to reduce reported leverage will pay the cost if the benefit, measured in market perception, exceeds it. Second, Repo 105 operated entirely within the perimeter of formally compliant transactions. Each individual trade satisfied the requirements of SFAS 140 as interpreted by the Linklater's opinion. The auditor verified the transactions. The legal opinion supported the accounting treatment. The disclosure framework did not require separate identification of the program. The fraud, to the extent the examiner's report identified colorable claims of fraud, was located not in any single transaction, but in the aggregate effect and in the absence of disclosure. This is a structural feature of accounting fraud built on the disaggregation of a single misleading outcome into a series of compliant components. Third, the verification chain failed not because any one gatekeeper missed an obvious violation. The auditor reviewed the transactions and accepted the treatment. The whistleblower escalation occurred through formal channels. The regulator was on site. The rating agencies received the disclosed financial statements. The failure was that the chain, as constructed, did not produce escalation when the question shifted from technical compliance to material disclosure. Each component performed its narrow function. The collective function of producing financial statements that fairly represented the firm's financial position was not performed. Fourth, the regulatory response in ASU 2011-03 focused on the specific quantitative threshold that had been arbitraged. The revision was effective. Repo 105 in its original form became impossible. The broader question, whether other accounting standards defined by quantitative thresholds remained subject to similar arbitrage, was not systematically addressed. The record on Lehman Brothers' Repo 105 program is closed. The examiner's report stands as the principal source. The civil settlements have been entered. The accounting standard has been revised. The firm itself was liquidated through bankruptcy proceedings that concluded years after the filing. These findings, taken together, describe a window. It was open for a brief number of days each quarter, during which 50 billion of a securities crossed an accounting line and then crossed back. The window has been closed by accounting standards revision. Whether other windows of similar structure remain open is a question the public record on the Lehman matter does not by itself answer.